Hi everyone. In this video I run through an example of cash flow estimation and capital budgeting techniques from chapters 10 and 11. This problem is part of your Moodle notes, and I suggest that you review the problem and attempt to complete it before watching this video. It has to do with the Johnson Furniture Company, and it asks you to do a number of things. For instance, it asks you to calculate cash flows, looking at the initial investment, the incremental operating cash flows, and then the terminal value. After you've calculated those cash flows, you will then need to calculate the net present value, NPV, the internal rate of return, and the modified internal rate of return for the proposed expansion project that Johnson is considering. In this video, what you will see is I have a couple of different pages here. I'm going to go out to the second tab where I've already developed a solution. And what I want to emphasize is when you do a solution for this type of a problem, I think it's a really good idea to write out your assumptions and information. So what you see here is I have information that I've taken from paragraph form and I've simply put it into a format that I can use in my spreadsheet. So I've identified the number of vans. In this case, that's 15. Johnson wants to provide delivery services for other furniture stores in the area. So they're going to buy a number of vans. We've got an estimate for the price of each van and the revenues they'll make per delivery, deliveries per week, things like that. We also have information about how those items, costs and revenues will grow over time. We have a 7-year project. We have a required rate of return, or a weighted average cost of capital, if you will. And we have the initial investments and changes in net working capital. All of these items should be familiar to you. The difficulty is putting them together in the proper format and making sense of them all. So what we're going to do here is we're going to start with cash flows, and we're going to begin with year zero cash flows. And as you might recall from year zero cash flows, we're looking at your initial investment, which will consist of a purchase price. In our example here, our purchase price, we have 15 vans. Each of those cost $35,000. Excuse me. We also have perhaps the resale of an existing asset. There is no existing asset in this example, so there's no resale. And we have changes in net working capital. As you bring new projects online, you may find yourself with additional inventory or additional additional accounts receivable, or perhaps even some additional accounts payable. Those items make up your net working capital, and we will assume that those change with our level of sales, and that they will be there will be an annual change in net working capital as a percentage of sales, and it will be 8% of total sales. So if you have a $100 change in sales, 8% of that would be an additional $8 in net working capital. Let's take a look at year zero. You can see we have net working capital is listed as $100,000, and the change in net working capital is also $100,000 because we started with initial net working capital of $0 associated with this project. The purchase price, 15 vans at $35,000 each. That comes to $525,000 right here. Our total initial investment, or at least the annual cash flow at year zero, is a negative $625,000. Let's just do a quick control squiggly here so you can see how I did that. I'm just going to look at this column of cash flows. You'll notice that all of the values that I have, I did not need to write in any numbers in my calculations. All of the values that I put into my cells are coming from my assumptions area on the spreadsheet. Change the assumption, the cells automatically change. Cash flows for the incremental operating cash flows. These cash flows will be, the process will be the same for each year. And you'll notice what I've done here, I've got revenues. So revenues, it seems to me, if we go back up a little bit here, we believe that we're going to have we're going to make $100 in revenue per delivery. Deliveries per week will be $20, or excuse me, 20 deliveries per week. We assume that we will be working approximately 50 weeks per year. Obviously, we've got a simplified example here, as there would be seasonality in a furniture store deliveries. We assume that we have 15 vans. So 15 vans, each making 20 deliveries a week, each doing that for 50 weeks of the year and making $100 each time. We multiply those numbers together, we're going to get revenues of $1.5 million for this project. Variable costs, $900,000. The variable cost in this example, we have labor costs. So the cost per week per employee is $600. We have 2 employees per truck. We have 15 trucks, and they will be operating again 50 weeks of the year. That comes out to about $900,000. Again, you have this information in Moodle. If you need to determine or to check how I put together my equations, you can go take a look at it in there. Fixed costs are listed as $450,000. The fixed costs are the maintenance on the vans each year. There's $30,000 in maintenance per van per year. That's $450,000. Earnings before interest, taxes, depreciation, etc. $150,000. That's the $1.5 million less our two expenses, our variable and fixed expenses. Depreciation, we're using straight line depreciation, $75,000 per year. So that will be 15 vans multiplied by $35,000 spread out over a 7-year time period using straight line depreciation. That is $75,000 per year. The 150 minus the 75 leaves us with earnings before taxes of $75,000. Taxes at a rate of 30% is $22,500. Leaves us with net income of $52,500. Our change in net working capital. Net working capital will be 8% of the $1.5 million in revenues. That is $120,000. We already had $100,000 in working capital. That's only an additional $20,000 in net working capital. Our annual cash flow will be equal to our net income, $52,500, less $20,000. It's the working capital. We're not collecting that as cash. Plus, we get to add back the depreciation, as that depreciation is a non-cash expense. Its value is in reducing your taxes. That gives us an annual cash flow of $107,500. Moving forward, that process just repeats itself. We have information here for annual rates of change in revenues and expenses, all provided, and easy to grab that information and to put it into your spreadsheet. So if you take a look at what I have here for the second year, come up and take a look at this formula. It says, well, let's take D45, well, that's revenues in the previous year, and multiply them by 1 plus B31. You notice I put dollar signs around that B31. That's an absolute reference. I will use that value each time. I'm just going to copy these numbers and drag them across. B31 is this cell right here. That's the growth in revenues of 5% every year. So my revenue growth starts at $1,000,005. It will grow by 5% in year 2, 5% in year 3, 5% in year 4, all the way out to the end. Similar information applies across the board. Unless it's a fixed cost or depreciation, those numbers are constant. Finally, we get to year 7, and in year 7, 2 items happen. Number 1, in addition to all of the ordinary cash flows that we would calculate, we have to recover all of that net working capital. So that's one of the reasons we were calculating the total in net working capital. This $160,000, that's money that's tied up in receivables or payables or inventory. We assume the project is going to end. We get the money back. We turn that into cash. We also have a salvage value. We assume that we could salvage this asset at the end of the time period for, where's that value here? somewhere, here we go, resale value, salvage value per van of $5,000, 15 vans, that's $75,000. We depreciated the asset to a value of 0. We need to pay taxes on anything we sell those though, or any positive value. So the after-tax value, after we pay taxes on the salvage, $52,500. So you see we get a really big cash flow out here. Again, if you're not quite following this, go take a look at that example that you have in Moodle, examine those cash flows, examine those equations to figure out where those numbers came from. Those are the cash flows. How do we get the net present value? Net present value seems like it should be an easy thing to calculate, but Excel has a little, I think of it as a glitch. It's well known. Most people realize that you're not actually calculating a net present value when you use the NPV format. You're actually calculating a present value. So I'm going to put these letters here, or my cursor over the NPV function. I'm going to come up here to look at the function key. I type in NPV. I give it the cash flows, or I give it the interest rate and the cash flows. Interest rate B42, that's the 11% required rate of return that was provided as an assumption. Cash flows run from cell D58 to J58. That's the first inflow, or the year 1 inflow, to the year 7 inflow. We do not include that initial investment in that amount. When I put in D58, NPV will discount that cash flow for 1 period. If we started with our initial investment, NPV would discount that for 1 period. So instead what we do is we calculate the present value of the inflows. That's exactly what the NPV function does. And then we add in this negative $625,000. So you can see how I did that up here. I took NPV for the cash flows for each period. I then added in the negative initial investment. Internal rate of return, much easier. Internal rate of return works exactly the way it's supposed to. Highlight every value, you get the answer. So I highlight the internal rate of return, C58, so I actually start with that initial investment. Highlight every cash flow, tells me I'm getting an internal rate of return of 26.9%. That's bigger than my required rate of return of 11%. Looks like a good investment. Positive net present value, again, a good investment. But we know that internal rate of return has some issues. It is too aggressive in terms of how we assume cash flows are reinvested. So a modified internal rate of return is a compromise between the internal rate of return and the required rate of return. That weighted average cost of capital of 11%. So for the modified internal rate of return, what I like to do is, again, I highlight all of the cash flows. So I start with this initial investment. I highlight out to the last cash flow. It then asks for a cost or a financing rate and a reinvestment rate. We assume that our financing rate is our required rate of return of 11%. That's the B42. We assume that this is an average risk project and it will also be reinvested at the average risk, again, at your required rate of return of B42. That comes out to a modified internal rate of return of 20.5%, better than the required rate of 11%, but not so optimistic as to cause disappointment if we don't realize close to a 27% rate of return on our investment. All three techniques agree this is a good project. So take a look at the material in Moodle, then come back and take a look at this if you have questions, and hopefully this will be of value to you in terms of calculating cash flows and the capital budgeting methodologies of NPV, IRR, and MIRR.